World stocks plummeted again on Thursday and government bonds hovered near multi-year highs after a series of rate rises from global central banks rekindled fears that aggressive policy tightening could drag economies into recession. Following a rally on Wednesday when investors welcomed the US Federal Reserve's aggressive move to raise rates by 75 basis points, its biggest rate hike since 1994 by buying shares. Two other aspects of policy tightening in Britain and Switzerland seemed to have sobered investors into focusing on the chance that economies could slow as rates rise. And MSCI's gauge of stocks across the globe slumped 2.25% to hover near a 19-month low. In New York, the Dow Jones Industrial Average dropped 2.5%, the S&P 500 shed 3.3%, and the Nasdaq slumped 4.1%. All three indices were trading at their lowest in at least 1.5 years. The dollar, which has benefited from rising US yields, flagged on Thursday, weighed in part by the Swiss franc, which surged after the Swiss National Bank surprised investors earlier in the day by raising interest rates for the first time in 15 years by 50 basis points. The Bank of England BOE also lifted rates on Thursday for a fifth time since December by 25 basis points, a day after the European Central Bank promised support to temper a bond market both fueled by hawkish expectations. Meanwhile, Japanese businesses are under tremendous pressure brought by the soaring prices of importing materials and international logistic costs as the Japanese yen has been depreciating rapidly against the US dollar since March. The Japanese yuan on Thursday plunged to its lowest level against the US dollar since 1998, according to a survey by Japan Association of Corporate executives in early June. 73.7% of Japanese business owners said that depreciation of yen had negative impacts on the country's economy, giving the reason that the decline has increased import costs and burdens on businesses and consumers. Niaga AWANI is the sponsor of a startup project for fitness products in Tokyo. The products that he sells are manufactured overseas and then transported to Japanese suppliers. He said that as the yen falls, the cost of importing products from overseas has sharply increased, aggravating pressures throughout the supply chain. Some suppliers also have to continue their deals with brands because of the contracts they signed, and they cannot increase the prices. Singapore is grappling with imported inflation caused by the weakening value of Singapore's currency as it tries to stabilize prices of consumer goods after rate hikes by the US Federal Reserve, said an economist recently. The country's headline consumer price index, or overall inflation, came in at 5.4% year-on-year in April, the same as in March, staying near a 10-year high. Meanwhile, the core inflation rate hit 3.3% in April, the highest in a decade. Core inflation in May, yet to be released, is also projected to hit another high. Tan Kong Yam, a professor of economics at the Nanyang Technological University, said commodity prices in Singapore are vulnerable to external challenges because most consumer goods rely on imports to meet domestic demand, although the Monetary Authority of Singapore (MAS) has tightened monetary policy 3 times since last October. The business costs that have been accelerated by sharp rises in global commodity prices and the disruption of supply chains will eventually squeeze domestic consumers. A third of Sudan's population is facing a food crisis due to the compounded impact of climate shocks, political turmoil, and rising global food prices. The United Nations Food Agency, in a joint report with the Food and Agriculture Organization, said that 15 million people face acute food insecurity across all of the East African countries, 18 provinces. The report noted that West Darfur town of Krenik, where tribal clashes claimed more than 200 lives in April, stands out as the most affected, with 90% of the town's people facing hunger. Living conditions have rapidly deteriorated across Sudan since the October military coup sent an already fragile economy into freefall, with the Russian invasion of Ukraine compounding the economic pain. Funding levels fall short of meeting humanitarian needs in Sudan, where 40% of the population is expected to slip into food insecurity by September, the report said.
WFP Sudan has just completed its food security assessment. Unfortunately, our worst fears have been confirmed. We estimate at this point in time that some 15 million people are going hungry in Sudan. Our projections for later in the year indicate that this might be increasing to some 18 million people. The main drivers behind food insecurity in Sudan are the economic crisis, conflict, a poor harvest, and now also the global impact and the fallout of the crisis in Ukraine.
The October 25th military takeover appended Sudan's transition to democratic rule after 3 decades of repression and international isolation under autocratic President Omar al-Bashir. Sudan has been on the fragile path to democracy since a popular uprising forced the military to remove al-Bashir and his Islamist government in April 2019. The coup also stalled 2 years of efforts by the deposed civilian government to overhaul the economy with billions of dollars in loans and aid from major Western government and international financial institutions. Such support was suspended after the coup. Let's take a look at the BizTech Asia, where we'll show a clip of discussion between host Brian Fernandez with guest David Koh, founder the Smart Investor Singapore on Asian Midday Marketwatch, where he will share insights on regional markets performance as well as take a deep dive into Asia Pacific markets rise after largest Fed rate hike since 1994. Take a look.
Well, and the thing is, so this is essentially what's going to be if next month predictions are proved correct, and there'll be another 75 basis point increase. We're going to essentially have an increase of 1.5% in interest rates just over a 2-month period. How is that going to look like across the Asia Pacific region as governments focus on trying to control food inflation in particular, but overall inflation as a whole?
Well, I think the point is, even if they do increase by another 0.75% in July, it's still not going to be enough, Brian. They still have to do an awful lot more. And that really was the subtext behind what Jay Powell was trying to tell the markets, that they will be very aggressive towards increasing interest rates. So I think, companies need to be very aware that interest rates are going to be on the rise. And in particular, companies that have huge amounts of debt or require funding need to be very careful. As a side note, Brian, I just saw on the news wires this morning that Revlon, the cosmetic brand, has filed for Chapter 11. And it just goes to show that no company is immune. Wow. If you carry debt, and in the case of Revlon, it's about $3 billion worth of debt, you're going to hurt. And in the case of Revlon, they also suffered from changing consumer tastes, being usurped in some ways by some of the smaller players in the cosmetic industry, and they were also hurt by the supply chain disruption. So there's going to be a lot of turmoil in the market, Brian, and anybody that is investing in companies need to, number one, look at their balance sheet very, very closely and just see how much debt they have on there, whether the debt is going to be able to be serviced by the company. And then secondly, have a look at their top line revenues, if it's being eaten away or eroded by competitors, and do they have that ability to raise prices? And I think in the case of Revlon, it was everything happening at the same time. They don't have the ability to raise prices. They have huge amounts of debt. Then they also have, the supply chain disruption. So I think it really is a lesson for all investors.
And David, it just brings to the fore the fact that we're just in the early stages of rate hikes. We're going to see a lot of companies going under just because they're not able to service their debts. But I want to ask you about how we should react also beyond looking at just the debt issue. And that's now something that I'm going to look at on a couple of companies. But let's talk about the Warren Buffett school of thought and what you talked about in an article that you just published on the Smart Investor, which you can check out on the Smart Investor website. You alluded to the fact Warren Buffett says he doesn't care really about what's happening, but really to just look at the companies itself. Could you tell us a little bit more about his philosophy?
Okay, it's not just Warren Buffett, but there's another great investor called Peter Lynch, and both of them are of the same mind, which is that we are at some point in time going to have recession. I mean, that is the way the economy works. And any central banker, any government leader that says, oh, we've solved the problem of recession, there is going to be no boom and bust, they are completely wrong. We are going to get moments when the economy grows very quickly, then we're going to get those moments when the economy starts to decline, and then we have a recession. Now, in the case of the Federal Reserve, we know it's going to engineer some kind of recession, because that is the only way that they're going to be able to break the back of the inflation cycle that we are in. And so as far as Warren Buffett is concerned, he looks at businesses. He says, how is this business going to perform? How is this business going to be able to generate revenue? And that really is the secret of investing, not only in the case of Warren Buffett, but also in the case of Peter Lynch. And Peter Lynch once said, that anybody who doesn't think there is going to be a recession is not ready for investing. When you are investing, you have to be ready for it.